The hot debate about Tesla reached a new high when many new investors piled into the stock over the past 2 years. All these new faces are now underwater on their investment, and most are asking the question of whether they've made a mistake. Is Tesla overvalued? Is it undervalued? Let's put emotions aside and look at peers and data. So, how to value a Tesla? In the past, it was difficult to determine the value of Tesla because the company was not making a profit. Companies that are not yet profitable and are still growing are evaluated differently than those that are already profitable. Now that Tesla is actually making money, we can use this information to help determine the value of the company's stock. We can now consider the company's earnings per share, EPS, and the price to earnings ratio when determining the value of the stock. These two metrics are particularly important in this situation. There are many predictions online about how much money Tesla will make in the near future. These predictions can be difficult to trust, but we can create different scenarios and assign probabilities to them to try and get a better understanding of what might happen. For example, if we predict that Tesla will make $5 EPS in 2023, we still don't know how much the stock will be worth because it could trade at the price multiple that is 25 times, which would make it $125 per share, or 50 times multiple, and that would make it $250 per share. And that's quite a variance, right? And it's possible that the consensus estimates at the moment around $4 per share for 2023 are too low, and there will be an upside surprise. However, it is also important to consider whether or not these consensus estimates are reliable indicators of price movements. In 2022, there were multiple revisions of estimates towards the upside, and yet the stock still performed very poorly, and many considered Tesla overvalued. So, what does P ratio reflect, and is Tesla overvalued? The P ratio is measured that compares a company's stock price to its earning per share. It can give an indication of how much investors are willing to pay for each dollar of the company's earnings. The higher the P ratio, the more optimistic are investors about two aspects: the company's future earning growth and the certainty and stability of that growth. And it's worth considering these factors when analyzing company's P ratio. So let's take a look at the first part, the growth itself. How can we quantify the growth and determine whether to consider Tesla overvalued or undervalued? When we take a sample of publicly traded US based companies, we can plot out the relationship between the P ratio and EPS growth rate. There is a strong statistical relationship between these two, and company's expected annual growth rate and its price to earnings ratio. If a company is not expected to grow at all, it will have kind of a baseline price to earnings ratio, which is around 13.8. And for every 1% of expected annual growth, the price to earnings ratio increases by zero point 0.8. So, for example, a company that's expected to grow at a rate of 10% would have a price to earnings ratio of 22, which seems reasonable. And we can use this statistical relationship to determine a hypothetical price to earning ratio for different growth rates. So the faster the company grows, the higher multiple it deserves. And this makes intuitive sense. And you can see now what multiples you might expect for companies at different growth rates. For 10%, around 22p seems fair. For 20% clip, 30 PE. Up to maybe if company is growing 50%, you can assign 54p around that. So let's remember those for later. And now we can look at the second factor, the certainty and stability of earnings. Investors use price to earnings ratio to determine how much they should pay for company stock. And since the expected growth rate have a high degree of variance, the certainty of those predictions is the second factor. Companies vulnerable to economic changes will be assigned lower multiple. And that's probably what market kind of expects to Tesla, right? Because many people still see it as a traditional automaker. So some investors are worried that the increasing number of new electric vehicle models on the market could harm Tesla's market share and profits. They are also concerned that Tesla may have to lower its prices to compete, which would impact its profits. These concerns may cause investors to be less confident in their estimates for Tesla's future growth. Elon Musk, the CEO of Tesla, has added to these concerns by making a wild range of predictions, promises, timelines that are not always met. He even mentioned himself Tesla being overvalued many times. And to understand how well Tesla will be able to make a profit in the future, we need to consider whether their position within electric market is likely to stay dominant and high margin, like an Apple's iPhone, or whether Tesla will slide towards commoditized low profit margin area, like Amazon's e-commerce business. And this will help us predict how successful Tesla's core business is likely to be in the future. So let's consider the following points. Tesla has a history of making good profit from its products. On the other hand, Amazon's e-commerce business has always been a money burner. In a competitive market, company's brand can be an important factor in helping and maintaining profitability. Tesla has a strong brand that is associated with status and identity. Some people believe that the company's vehicles, similar to Apple's iPhones, are seen as luxury and are purchased for that reason. Thirdly, to completely eliminate its profits, Tesla would have to slash the average price of its vehicles by around 10K across the board and not benefit from increased efficiencies from their new factories in Berlin and Austin. And this would be unusual for the company and would also likely have a negative effect on its competitors who are already spending a lot of money to bring their own new electric vehicles to the market. Fourth point, Tesla's market share of global vehicle sales is less than 2%. Its market share of the global vehicle fleet is also less than 0.2%. This means that there are still a lot of room for Tesla to increase its sales. Even a small price decrease could significantly increase the demand for the company's product. Fifth point. As Tesla begins production at its two new advanced factories, and at the same time the cost of materials decreases, the companies may be able to lower its prices without significantly impacting its profits. And the last point, Tesla's recently made its full self-driving technology widely available in the North America, and it costs 15K to purchase. This technology has extremely high profit margins, and if more people start using it, it could help to maintain the overall company's profit even in difficult economic conditions. Based on these factors, we will choose the correct multiple in the next part to find out if Tesla is actually undervalued or overvalued. So, what would be the fair value? And for that, we have to look at possible peer group. So, uh, initially, we looked at the market in general, right, for different PE scenarios. But now let's take a look what we could consider a fair comparison. How about legacy automakers? Well, they produce similar products to Tesla, but they not be useful for comparison when determining the value of Tesla. Because these companies may not have the same expertise in battery technology or software, and their traditional combustion engine technology may become less relevant in the future. These companies also have smaller goals for producing electric vehicles and may have less access to funding due to heavy debt burden and low profits. Because of these factors, it may not be appropriate to use these companies as a comparison when evaluating Tesla's value. So, how about some of the new EV startups? They are publicly traded, but none of them are currently profitable. It is unclear when or if these companies will become profitable or how much they will produce. Investors are buying their stock based on the hope that they will be successful in the future. These companies are thus not useful for comparison. How about other battery players? Well, it might be an interesting comparison as Tesla generates 50% of their revenues in the US, which includes electric vehicles, residential and grid scale storage, and solar. This gives them a very special business risk profile, characterized by very little demand concerns. Products based on batteries will sell like hotcakes in the US for years to come, and key challenge is about having the right product and the ability to scale production. Companies with US battery exposure are therefore quite relevant peers for valuation purposes, especially if they are profitable today. How about big tech? Well, they operate in very different industries, but they are united by the fact that they are all very valuable and have both high growth and very healthy profit margins. These companies also tend to attract similar types of investors and thus compete for the same investors' money. What about China? Well, China has done more than any other country to promote the adoption of electric vehicles. It is possible that Chinese electric vehicle manufacturers will be as successful as Japanese car makers in the 1980s. In the future, the most successful companies will be those with expertise in battery technology. Of the companies that have the potential to challenge Tesla, BYD is the most promising. It has demonstrated its ability to produce electric vehicles at a large scale and achieve profitability. Therefore, BYD is the only company from this group that has been included in the comparison. So, overall, the final peer group consists of the following: Apple, Nvidia, Meta, Microsoft, Google, BYD, Enphase, and SolarEdge. And you can see what is their current P ratio and what P ratio would be fair based on their earnings growth. And from the chart on the screen, you can also see which companies are expensive, above the trend line, or inexpensive, below the trend line. And as you can see, Tesla is safely below the trend line and thus undervalued. Taking the expected EPS growth, Tesla should command at least P of 35 based on the low EPS consensus. However, I believe Tesla will soon got to commanding P of 40 to 50x. And here is why. Tesla plans to increase its revenue by more than 50% each year for the foreseeable future. This goal is supported by the company's expansion plans, including its effort to increase its production of batteries. The company's profit are also expected to grow at a similar rate. If Tesla's earnings per share in 2023 are $4 and the company stock is currently trading at 30 times that amount, approximately 120, and the EPS grows by 50% each year, then by 2025 the EPS would be 13.5 US dollars and the stock would trade at a multiple of 8, 8 PE. This would indicate that the company's growth is slowing down. Even if the market does not believe that Tesla will be able to sell 20 million vehicles per year by the end of the decade, there is still at least 3 years of visible growth for the company, and the market will eventually recognize this. And thirdly, BYD currently trades at 39x PE, or in other words, 35% premium to Tesla. And it should be the other way around, since Tesla is a US-based company with lower political risk and more transparency. It has proprietary FSD technology, better margin, better brand value, and no exposure to internal combustion engine. So, as a conclusion, Tesla is definitely undervalued. And based on the previous set of data, we can plot out what are the possible scenarios of Tesla valuation. On the left, on the left axis, you can see a different P ratio that the market might assign to Tesla, and on the horizontal axis, you can see a different possibilities of earnings per share for the following years. So let me know in the comments, what P ratio would you expect the market to assign Tesla by the end of this year? And what do you expect from the earnings per share? Let me know. And if the market this year turns out to be even barely reasonable, I think Tesla stock will come back roaring. It's inevitable. Tesla is not overvalued.